Hey everyone, and welcome back. In this advanced modeling challenge, we are building on the fully integrated financial model from the last lesson and taking it one step further. This time, your task is to implement a real-world carve-out, often seen in lender term sheets, a dual DSCR debt sizing constraint based on both P50 and P99 production. Here's a quick look at the final model. You will learn how to generate flexible energy yield scenarios using uncertainty assumptions, and dynamically size debt based on the minimum of 2 DSCR requirements. You will also see how these constraints affect the amount of debt you can raise, and what that means for equity returns. If you would like to follow along, you can download the case study PDF and the model start file for free. Just click the link in the description below and select Free Preview. This challenge builds directly on the model we created in the previous lesson, so you will be starting with a fully integrated income statement, cash flow statement, and balance sheet. Now, let's take a quick look at the updated case study so I can walk you through what has changed. Alright, Advanced Financial Modeling Test P99 Constraint Debt Sizing Case Study. Case Study Overview. This case is part of a realistic financial modeling test used to prepare candidates for infrastructure investment roles. You're evaluating a fully operational 150 megawatt peak solar PV plant located in the country of Solenta. The project has a 30-year fixed price power purchase agreement, PPA, selling all generated electricity under a pay-as-produced structure. In the previous module, you built a complete financial model from scratch, including a fully integrated cash flow statement, income statement, and balance sheet, using P50 production assumptions and a 1.3 DSCR constraint to size senior debt. In this advanced challenge, you are asked to go one step further. The twist. You have just received a second debt term sheet from an alternative financing partner. This new bank offers slightly more aggressive leverage, but with one critical caveat. Bank 2 proposal. Target DSCR P50 is 120 versus the 130 in our original case. So technically that should allow us to raise more debt. Additional sizing constraint. Debt must also satisfy a minimum DSCR of 1.0 on P99 production. The more constraining of the two, i.e. P50 at 120 or P99 at 1.0, will govern the final debt quantum. So we can get too excited because we don't know yet whether this new proposal will actually end up in more or less debt than our original proposal. Because in the original proposal, we didn't have a P99 constraint. You are also provided with a new assumption. P50 yield uncertainty is 10% standard deviation. Okay, this input we will need to calculate our P99, P90 or P75 production. Quick side note, 10% standard deviation for a solar project is really high. Usually that's around 4 or 5%. But since this is just a basic case study testing your conceptual understanding, the 10% should be fine. That's probably a more realistic standard deviation for a wind project than for a solar project. All right, let's keep reading. What do you need to figure out? Would the second bank's proposal improve or reduce the levered equity IRR compared to the original base case, which was the 130 P50 DSCR only? What if you could negotiate away the 1.0 P99 constraint and use only the 120 P50 DSCR? Well, we should already be able to answer this question by simply just changing our current 1.3 input in the model to 1.2 and see what happens to the equity IRR. Would removing that additional 1.0 P90 constraint materially enhance your IRR, or would it make no difference? So that just really depends on whether the P50 CFADS or the P99 CFADS will be our constraining factor. Your task: adjust your model to incorporate a P99 energy yield scenario using the provided P50 yield and a 10% uncertainty assumption. That should be pretty straightforward. Sculpt the debt under both constraints, 120 DSCR on P50 production and 1.0 DSCR on P99 production. Now that's a little more challenging because we have to arrive at two different CFADS. CFADS on a P50 basis and CFADS on a P99 basis. Determine the minimum of the two resulting debt amounts for each period. That's what we will do using two different CFADS assumptions essentially. Recalculate the levered equity IRR using this new optimized structure. Then repeat the analysis with the P99 constraint removed to isolate its impact. So we should probably also integrate a toggle in the model which allows us to turn the second constraining factor on and off. So let's keep that in mind for our input section. This exercise is designed to test your ability to handle advanced scenario logic and probabilistic downside scenarios in a real-world financial model. Key reminder: you have already built the full model infrastructure, including all 3 financial statements in a prior challenge. You will now use that framework as your base to implement scenario-driven DSCR sculpting logic and assess debt structuring trade-offs under yield uncertainty. Okay, this is certainly some more advanced stuff for a basic financial modeling test. Deliverables. Once you have completed the model adjustments, report levered equity IRR Bank 2 with P99 constraint and also without the P99 constraint. By the way, the second ask we should already be able to answer by simply just changing our current 1.3 DCR input to a 1.2. Comparison to base case. Bank 1, 130 P50 only. Conclusion: is it worth pursuing Bank 2 and negotiating the carve-out? Okay. Key parameters for reference. So these are all the same inputs as in our previous lesson, except we have one additional input, which is our standard deviation of energy yield uncertainty of 10%. All other assumptions remain as previously modeled. Download. Be sure to use your completed file from the previous module, 3-statement integration, as your starting point for this challenge. If you didn't complete the previous lesson, you can download the pre-built model using the link below. Ready to be tested? This is exactly the kind of follow-up prompt you might face in a real interview. A last-minute term sheet tweak, a dual constraint, and an equity investor looking for a recommendation grounded in solid Excel modeling. Let's see if you can rise to the challenge. Now, before we get started, guys, just a quick heads up. Like the other walkthroughs in this series, this session is fast-paced and designed to mirror the time pressure of a real modeling test. I won't break down every Excel formula or theory along the way, but it will guide you through each key modeling step so you can build this from scratch in your own workbook. If you would like more foundational theory on yield uncertainty, DCR sizing, or Excel logic, check out the structured lessons at renewablesvaluationinstitute.com. All the relevant links are below. And with that, let's jump into Excel. Alright guys, I just opened our model start file, which you can download using the link below. We will start with our input section because what we did here the last time is integrate our P50 energy yield on the basis of full load hours and then calculate our total generation. Now we are given one additional input, which is our 10% energy yield uncertainty, which now allows us to calculate any p-value, not just P99, we can really calculate any p-value. So first thing we will do is add a few rows here, maybe 10 rows or so. And what I really like to do in all my models is I like to introduce a selection for the end user. So we write generation selection, and this will be a choice. And we will have a drop-down right here, which will allow us to select from a P50, P90, or P99 production yield. I'm also going to show you how to calculate a different p-value than P99, just that you get it conceptually. But before we can introduce the drop-down, we will first have to generate our net generation in a dynamic way. So let's write net generation. And then let's use the same unit as for our full load hours, so megawatt hours per megawatt peak. Net generation in megawatt hours per megawatt peak. We can bold this. And what I like to set up here ultimately is P50, P90, and P99. However, since we will be using the norm_inf function to calculate our dynamic yields, we have to delete this and just put in 50, 90, and 99. We do this because our norm_in function only works with numeric values, but that the end user gets what we're doing here. We will select all these cells, hit Ctrl+1, and we will do a custom formatting and write before standard, we write in quotation marks P. Hit enter. Then we can have a left alignment. And the P50 value shouldn't change, so let's keep that as is. And for the other two, Alt-HJ, we can have an input. Let's do a left alignment again. Left alignment. And what that basically tells the end user is that they can change our P value. And you can see our value in our formula is actually just 90, but it's displayed as P90. So the end user could technically change the P90 to, let's say, 75, P70, or P90. Let's just stick to P50, P90, and P99 for now. Then the unit here will be the same. Copy this, paste it here. And for the P50, we just do a simple reference of the input that we have created before. So let's just pick up this value right here, hit Alt-HJ. Let's just select an offsheet style so we can see this is actually coming from a different section. Okay, and before we will be able to calculate our P90 and P99 using the norm inf, we will also need our uncertainty. So let's write that right under here. Uncertainty or standard deviation will be given in %. So we can just pick up the degradation style right here, copy this cell, paste it here, and let's write 10%. That's what's given in the case study. And now what we can do is calculate our P90 and P99 based on our median, which is the P50. The P50 is always our median energy production. And then we have our standard deviation, which we will need for calculating any other p-value. So norm inf right here. If you want to understand the norm inf function further, check out our courses. But for now, I'm just going to show you how to actually implement it in the model. So for the probability, we always start with 1 minus, and then in parentheses, we take our P90 value, which is right here in cell D19, and we'll anchor this to our column only. So hit F4 3 times. And since the norm in function thinks in percentage points, we have to divide our input of 90 by 100. So essentially it's just 90 over 100, close parentheses. And that will result in 1 minus 90% is 10%. So the norm in function works the other way around. If you want to know the energy yield that will be achieved in 9 out of 10 years, then essentially the norm in function looks at a 10% probability chance that this threshold point will be met or exceeded based on a normal distribution. Comma, our mean is our median, which in our case is our P50 value right here. We fully anchor this value, so hit F4 once. Comma, and then we need our standard deviation. Now this is a little tricky, so first we pick up our 10%. Let's also fully anchor this one, F4. But our norm in function again doesn't think in percent for the standard deviation, but in absolute values. So what we have to do is take 10% times our P50 value. So that's the standard deviation in absolute terms. Hit F4 again, once to fully anchor this one. Close parentheses, hit enter. And this seems to work fine. Hit Alt-HJ. That's a 0 style. Alt-HJ again and select an in-sheet style. Now, if you got the anchoring right, we should be able to drag it down. So hit Ctrl-D in the cell underneath. Hit F2 and we can see our P99 is referred to as well as the uncertainty, and the median reference is still correct. Cool, and what that tells us is that in 99 out of 100 years, our solar park should at least produce 1,611 megawatt hours per megawatt peak. Only in 1 out of 100 years, this threshold point would be expected to be breached. So in 99 out of 100 cases, we would expect an energy yield production at or above this value. And this is why banks are often providing a DCR sizing constraint on a P99 cases and a 1.0 DCR, because they say if we have certainty to receive that in 99 out of 100 years based on the energy production, then we are willing to provide that on these terms and conditions. Okay, cool. Now that we have our different generation assumptions, we can mark all our 3 different P values and we create a list name. So we'll call this in our name box list underscore generation, which will allow us to create a drop-down menu. So in F15, I'm hitting Alt A V V for data validation, hit tab, and we will select a list, enter the source. For the source, we hit F3 and we select our list generation. Okay, hit OK. And what you can see now, we can actually select a P50, P90 or P99 scenario. Let's just select a P50 for now. You can see the formatting is not right yet. So hit Ctrl+1, custom, and select our previously created style. Okay. We can center this alignment, hit Alt-HJ and select an input. So it's clear that this is a selection. Let's actually center this one more time. And now if we hit Alt and down key, we can select different generation selections. Well, now we have a fancy toggle to select our generation. However, it's actually not flowing through the model yet, so it doesn't really help us until we create a live model scenario. So we write live model and say applied annual generation. That will be given just like this one in megawatt hours per annum. Copy this unit, paste it here. And this will be the output, which we will then link into our calculation sheet and model logic. So to select our live case based on a generation selection up here, we will use a SUMIF function. Write SUMIF. We will select our list generation first. So this is our range from which we want to select, comma. The criteria is actually our drop-down. So the SUMIF will essentially just look up which value corresponds in this list with our selection, comma, and whatever value matches here, we want to pick up this row. So this is the sum range, or better, this column. So if you select P99, it will pick up the 1611. If you got the formula right, close parentheses, hit enter. And you can see we select this value here. Let's see what happens if you select P90, P50. You can see it selects a proper value. So switch back to P99. Hit Alt-HJ, that's a comma 0. Alt-HJ, that's an in-sheet calculation. And then since we're now trying to figure out our applied annual generation in megawatt hours per annum, we will also have to multiply this by our installed capacity up here, which is 150 megawatt. Hit F4, hit enter, and you can see that our P90 production is significant, or P99 production is significantly below our P50 production up here. And let's double check whether this all flows through correctly. So let's select P50 and you can see both values here align. Okay, and now what is going to be important is we first have to figure out what's actually flowing through the model right now. So what we do is we go into our total generation cell F11, go to formulas, trace dependence, and let's see where this value is actually going. You can see it's just flowing into one single cell. Double click this, which is G21. Here we are calculating our net generation before degradation for our live model. So what we need to do is we need to change this input or reference. So this equals now our live model down here. Hit enter. And obviously this label here now is also misleading. So we want to make sure that in the live model, it's actually displaying our choice. So we can link this label here to our dropdown. And now again, we need to format this style. Go to custom, select our P style here. Okay. And now let's see what happens also to our IRR. Right now we are at the 10.53 IRR. And let's select the P99 scenario. Go to our calculation sheet. You can see our label has changed. Our input for our renewable production has changed. And our levered equity IRR is now at 4.7% instead of 10.5%. So this seems to flow through properly. That's great. Let's flip it back to a P50 production. Remove arrows. And now this value here is not going anywhere. So to avoid confusion for end users, let's actually delete this row, hit Control minus. And now we have a dynamic model which allows us to select different energy yield productions via dropdown. So that's great. Let's quickly flip back over to our case study. And we are asked to sculpt that under both P50 and P99 production. So now we have an issue in the model. What we have here is a selection of P50, P90, or P99. So that only allows us to actually have one energy generation selection flowing through the live model. Now, if we are supposed to size that on two different P values, that is really difficult if the live model just considers one of the two production values. So what we need to do here is, let's give this one more row. We will calculate our annual generation based on these three P values at any time down here. And then we'll pick up these values for our debt sizing so that within our debt sizing, we can actually consider different CFADS based on different generation selections. And to keep the model as dynamic as possible for the labeling here, I would like to flexibly refer to whatever is input right here. So instead of just saying total P50 or P90 energy generation, I want this to be dynamic. So what we'll do is equals in quotation marks total. And then we'll have our P value, but since these inputs here are numeric values, we'll write total P quotation marks. Then we'll write an and sign. Select our input right here, which is our P50 value. So this should read total P50. Then we will do another and sign in quotation marks. Then we will need a space. So hit spacebar once, energy generation. Quotation mark one more time, hit enter. And that works great. It reads total P50 energy generation. Hit Control D, and you can see now this is reading P90, P99, and if someone changes this to a 75, the labeling changes accordingly. Hit Control Z. This will all be given in megawatt hours per annum again. Pick up the label. And this is fairly straightforward. So we take our full load hours up here and multiply these with our install capacity, which needs to be fully anchored. So hit F4 once, enter, Alt HJ, that's an in sheet. Drag it down. And let's double check what happens to the live case if you select the P90 and these two numbers align. That's great. And then you can see that this section here will be what's flowing through the live model and what will impact our ultimate equity IRR or levered equity IRR. But we still have the flexibility to put all these inputs into our debt sizing, bypassing our live model case. And this is really what this dual constraint is about, that you figure out a way how you can have two different generations flowing through the model, bypassing what's actually considered in the live model for the equity IRR calculation. All right, we are not done yet with our input section, so we will have to scroll down, and for our financing assumptions, now we do have an additional target DCR. So let's add 2 rows here, hit Control plus 2 times, hit Control D for this one, and we will just relabel this as target DCR P99, hit enter. That's also given as a multiple, hit Control D, and this will be a 1.0 DCR. Let's flip back to the case study. So now we also asked, would removing that additional 1.0 P99 constraint materially enhance your IRR? So if you really want to show off here, I recommend you put in a toggle where you can turn your P99 constraint on or off. And there's a best practice way of doing that. So first we can write P99 constraint on off. That will be a choice again. Let's select the unit style here. Now, if you don't have time, you can just write 1 or 0 here. But, you know, it's not really intuitive for an end user to write 1 or 0. So what we do instead is add a few rows down here, hit Control plus 3 times, and then we will write technical inputs, Alt HJ, that's a header 1. And we will have an on and off technical input. So for on, we want a 1, similar to a flag, and for off, 0. Mark both these inputs, hit Alt HJ, and select a technical input style up here. Hit enter. And now we will change the way the 1 and 0 is displayed by hitting Control 1, going to custom, and let's erase the standard here. If you're not familiar with how the custom formatting works, I recommend taking our other courses, but here we'll just focus on actually implementing it. So in quotation marks, we will write on, then 2 semicolons, 1, 2. The middle one would be how a negative value would be displayed. This is a positive value, a negative value, and then for our 0 in quotation marks, we write off. On 2 semicolons, off. Both in quotation marks, hit OK. And now we can see we still have a value of 1, that's on, and 0 is off. Now we mark both these cells. In the name box, we will name them list underscore on off. Let's go up here, P99 constraint on off, hit Alt A VV for data validation, select list, tab, hit F3, and we select list on off. Okay. Okay. Now we can select on, which gives us a 1. So hit Control 1, go to custom, all the way down, select our new style, hit OK, Alt HJ. That's an input. If that was too fast for you, I recommend you taking the Excel DNA course on renewablesvaluationinstitute.com. That will get you up to speed with this kind of stuff. Cool. Now we have all the inputs we need to fulfill our case study task. So we have a second target DCR on a P99 level of 1.0. We have a toggle to turn this constraint on off, and we have all the energy productions we will need. Now the case study asks, what if you could negotiate away the 1.0 P99 constraint and use only the 1.2 P50 DCR? So let's go to our output summary and say summary of key outputs. Delete that on a P50 basis because that's not the case anymore. Let's add a few rows here. And we actually need a little more width. 15. We can delete this row. And we will write levered equity IRR bank 1. Control D. We can name this bank 2. In parentheses, including P99 constraint. And then the last one is excluding P99 constraint. Let's pick up the unit style here, paste it here. And what we'll do is we will paste hard-coded values here. So right now, we are still considering a 1.3 P50 sizing DCR. So we haven't really changed any inputs from our previous case study. So we pick up our levered equity IRR as hard code, copy this, paste it here, Alt HV as V for values only, enter. Let's pick up the formatting for all these cells here, Alt HV as T for formats. And now that we know what our levered equity IRR bank 1 will be, we can change our input to align with our case study. So our case study says the new bank proposes a 1.2 DSCR on a P50 basis, which would leave us with a levered equity IRR of 11.74%. Copy this, paste it here. So we can already answer one of the questions and say certainly bank 2 proposal would be way more lucrative if we were able to negotiate away the P99 constraint. But as of now, the term sheet does include a P99 constraint, so we don't know whether this IRR will actually be higher or lower than our 10.5%. But we could certainly with confidence say if we get rid of this P99 constraint, then we would indeed end up with a higher levered equity IRR. So now that we have set up our output summary sheet to ultimately show decision makers what our case study results will look like, and we are done with our inputs, let's flip over to our calculation sheet to ultimately implement that constraint. And before we get going, I always like to pull in a few infos and checks up here in the top section of the sheet so that when we make changes, we can see whether the model logic still holds true and what happens to, our levered equity IRR and production scenario. So let's actually pull in our production and also our levered IRR. Let's bold this. Our production equals our selection right here. So link it right here, hit Control 1, go to Custom Styles and select this P style. Alt HJ, that's an offsheet. It's not an input. Then our levered equity IRR, we could pick it up from further down here, but let's just use it from our output summary. So that's right here. Oops. And Alt HJ, that is going to be an offsheet item. And let's just write live right here so everyone knows it's a live case or live model. Use a table style. So now we can clearly see this is our live levered IRR based on a P50 production. So let's see what happens if we switch it to a P90 production. We can see our levered equity IRR drops significantly. And this just helps a lot to see what's going through the live model right now. Flip it back to P50. And then let's also pull in a master check. Hit Alt HJ. Select the table style. And for our master check, I like to use an if function. And then we take the sum of. In the last lesson, we have created a balance sheet check. So let's pick up this number here, or this check, cell E5 on our fin statements sheet. comma. Then we go back to our calculation sheet. And right down here, we have two different checks. So this, comma, this, close parentheses. And if the sum of these three cells equals 0, then we want a 0 to be returned, otherwise a 1, which would turn on our fail or flag that there's something wrong with the model. Close parentheses, hit enter. So we get a 0. Let's pick up this check style, hit Control C, Alt HVST, enter, and we can see our master check currently is okay. And since we will be grabbing quite a bit into the model logic and integrity, it's always good to have an eye on what's going on with the master check and whether anything is failing. All right, and without wasting any more time, let's actually now look at our senior debt section. And now let's just think that through for a moment. For sizing our debt, we first arrived at our CFADS right here at the top of our senior debt section, and then calculated our lever taxes based on these CFADS or EBITDA. Once we arrived at our CFADS, we used these to determine our target debt service based on our target DCR on, here in this case, a P50 basis. Now what our ultimate goal will be is to calculate CFADS on two different production scenarios. One time on a P50 basis and one time on a P99 basis. And since these CFADS change based on our input choice in our input sheet, we will have to add quite a few rows to determine the CFADS independent of our life choice. So let's see what happens once we change our production input from P50 to P99. Right now we have 755 million CFADS. And when we change this, you can see our CFADS change quite a bit. And what happens is that our target debt service now is picking up for our P50 sizing, our P99 CFADS, considering the P50 DCR target. So this is not what we want. So certainly we need to determine CFADS independent of our life choice. Let's flip it back to a P50 scenario. And now one issue we'll have is that we can't just override this and say, for this row, we will not consider the life case anymore, because when you trace dependence for these CFADS here, they don't just flow into our target debt service, but they also flow into our dividend calculation, which ultimately drives our equity return. So what I would like to do is let's relabel these ones, and we will just write live. So it's clear these are our live CFADS. Write it here again, just to make it crystal clear. This is the live model, also live EBITDA. Or actually, let's write this in parentheses right behind. Otherwise, it's going to get a little messy. Live. Copy this. Let's pick it up here. Plug it in here. Let's do the same for our lever taxes. So it's crystal clear now, this is the live model. And what we will ultimately try to do is determine at this same number, the CFADS right here, which ultimately considered also lever taxes based on the production value, to then link that into two different targeted services, one based on a P50 production and one based on a P99 production. So remove these arrows, and what we will do is we will need a lot of additional rows to replicate this whole calculation and adjust our EBITDA based on production levels. So hit Control plus maybe 30 times or so. We will need quite a lot of new space. So this should give us quite some space. And then let's move up and we will start with the header, which we'll call CFADS, using different sizing constraints. Let's bold this. And to arrive at our CFADS, we needed our EBITDA. But if you move up, you will see that to arrive at our EBITDA, we will have to figure out what is our total production first. Once we have the production, we can calculate our revenue, which is only our PPA revenue. Then we also need to consider our operational expenditures before arriving at our EBITDA. And thankfully, 3 out of 4 OPEX line items are based on installed capacity only, so they don't change depending on our production. However, our land lease cost is actually linked to our revenue, which means we will literally have to model 3 different land lease expense scenarios based on different productions. Because if we produce less electricity, we will also have to pay less land leases. Then once we have made all these adjustments, we can arrive at our EBITDA. And once we got the EBITDA, we will have to calculate our levered taxes. And you guessed it, our levered taxes will also change depending on the production input. So we'll have to replicate this whole section also for the P50 and P99 production, independent of the live selection. Okay, I say we better get to work. So we will start with our total generation, considering different yields. Control U, underline this. And then we pull in our total generations right here. Control D. That will be given in megawatt hours. Let's pull in our ultimate input that we calculated right here. Control D, Alt HJ, comma 0, Alt HJ, that's an offsheet. Pick up some row totals from up here. And now this will equal, first of all, our operations flag, hit F4 1, 2 times our availability assumption of 99% right here, hit F4 once, fully anchored, times, let's also multiply it directly with our degradation discount factor. Otherwise, we will just have endless rows to calculate all this stuff. So calculate it with, or multiply it with row 22. Hit F4 1, 2 times. And then we will also have to multiply this with our production selection here. And here we have to anchor to the column only. So hit F4 3 times. Enter. Control D, drag it over. And nice, you can see our total production over the asset lifetime, depending on these 3 cases. Let's double check whether the P50 aligns with our generation further up in the live case. 8932, 8932. Great, let's double check if the P9 is also, or P99 is also flowing through correctly. You get 6854 and 6854. Awesome. Flip it back to P50. Then after our generation, we calculated our total PPA revenue. So right, total PPA revenue considering different yields. Control U. So for the labeling, again, let's write equals in quotation marks P quotation mark, and let's select this reference here. And then while we're still in the formula, let's write and in quotation marks, give it one space, so space bar, total PPA revenue, quotation marks, and hit enter. So this gives us the P50 total PPA revenue. Drag that down. So since I haven't anchored it initially, we have an adjustment of P50, P90, and P99. But I want to copy and paste this formula later to do the same for our next labels like land lease and OPEX and so forth. So now I fully anchor all of these references here, here, and here. Hit F4 once each time. Then we also have a dollar unit input. Pick up raw totals. And that leaves us with 3 labels, and we can calculate our total PPA revenue. So for our PPA revenue, we start with our PPA flag, PPA term up here, hit F4 2 times, do not forget our PPA escalation up here, hit F4 2 times as well, times our PPA price, which is given down here, $75 per megawatt hour, hit F4 once, and then times we multiply this with our total P50 energy generation. Let's not anchor this, so we can actually drag the formula down and to the right. Alt HJ, that's a comma 0 style. Control D, drag it over, Control R. So let's cross-check whether we got the anchoring right. For the P50 total PPA revenue, we have 999.4 million. Same as up here. That works. Let's double check with P99. 766.9 and 766.9. Great. Flip it back to a P50 production. And now this is one of the really tricky parts for this case study, is that we actually have to adjust for our land lease expense. And that's something that a lot of candidates will miss. So you write land lease considering different yields, Control U, and then we pick up all these labels here, copy, paste, and for this one we write land lease. Copy that wording and paste it here and here. Great, that will also be given in dollars, so we can pick up these guys here, paste them here. Same goes for the row totals. That's actually fairly simple, so all we have to do is multiply our total revenue times our 2% of revenue land lease expense. Hit F4 once, hit enter, Control D, Alt HJ, comma 0, drag this over, Control R. We get 19.98. Same as up here. Cross check. 15.38, 338, same. Great, let's flip back to P50. And that means we can calculate our total OPEX. So let's just pick up all of this stuff here to save time, paste it here. We write total OPEX, copy total OPEX, paste it here, here, and here. Now our total OPEX is going to be the sum of these 3 rows here, which are all linked to our installed capacity. Hit F4 2 times to anchor to our rows, plus our P50 land lease. Okay, that's weird. Okay, let's try that again. So this refers to K91. Hit enter. Control D, drag it over. Control R. Let's see if that aligns with our live model. We got 144.1 total OPEX P50, and under P99 we get 139, and that aligns with this number here. Great. Let's flip it back to P50. Now let's do the same exercise again, pick up all of this here, and we can finally arrive at our EBITDA. Copy this, EBITDA. Paste it here, here, and here. Now you might recall from our last lesson, our EBITDA is simply the difference of total revenues minus total OPEX. So let's do the same here. This equals total revenue minus total OPEX. Control D, drag it over to the right, Control R. 855, 627, these numbers sound familiar from earlier. Well, and we are still not done yet. We have the EBITDA, but as you might recall, to calculate our live CFADS, we also need to subtract our lever taxes, and these will change depending on the production scenario you select. So we actually will calculate the lever taxes for P50 and P99 only, so we'll have to pick up all of this stuff here. And to make it as efficient as possible, first we need some space here. Hit Control plus maybe 10 more times, give it some more space. And let's check all the references and anchoring here. So this labeling we will have to change. K40, this reference we will need to change. This reference can stay the same. Some of this EBITDA, we will have to change this. Actually, we just pick up this, sorry. So this reference need to change. Our depreciation is picked up here. The depreciation expense won't change, so we don't want this reference to keep moving. So what we will do is we will anchor this, hit F4 2 times right here. Then this is fine. Our debt interest is referring to our calculation down here. We don't want this to change either, because once our debt quantum is fixed, and this will be probably a question that a lot of students will have, is our debt interest changes on production scenarios. However, once we have sized our final debt quantum based on these two constraints, in that moment in time, we will have a financial close where a final debt quantum has been determined, and this final debt quantum won't change and won't affect interest anymore. After the deal has been structured, the interest is what it is, and our interest expense will not change depending on the production. That's actually a question that I'm getting a lot, but just for clarification, this interest will not change. So what we will do is hit F4 2 times to anchor to our row. EBT is the same, and this here, our reference to our tax rate here, let's actually change the anchoring here and hit F4 2 times more. So it's only anchored to the column, hit enter. And then for this one, we will hit F4. So this reference doesn't change. Now we have changed the formulas for 2 rows. So we take all of this, drag it over, Control R. Nothing should change. It's just some referencing. And now we can take this whole section, select all of this stuff here, copy it, and paste it here. And we will rename this as P50 levered taxes. Or you know what? Let's actually pick up this right here, paste it here, and we write levered taxes, Control U, and then we should adjust our EBITDA reference that's referring to up here. So we take this and now refer to our P50 EBITDA. Let's anchor this 2 times, drag it over, Control R, and we get lever taxes of 99.4 million right now. Let's see if that aligns with this right here. It does. Let's check all references. Depreciation is still referring to the right row. EBIT is fine. Debt interest still referring to down here. Our EBT is fine. Lever taxes is referring to this out. Great. Let's do the same again. Copy this, paste it here. And you know what? Let's just focus on the actual task and we will focus on our P99. So let's change the reference to 19 here. So we only have our P99 lever taxes. This is a little overkill to also do this for P90 now. Drag this over. Actually, first we need to change our EBITDA reference. And here we refer to our P99 EBITDA. Enter. Drag this over, Control R. Now let's check what our lever taxes would be if we change the live case to P99. That should align with this number here. So the 52 million should equal this number here. It does. Great. And you might have noticed that this number just jumped right now. Why is that? Because our energy production ultimately affects our debt quantum down here. So that's to be expected. Let's flip it back to P50. And now we are finally at the stage where we want it to be. Now we can calculate CFADS considering different yields. Control U. And we can pick up this style here, copy this, paste this. We will write CFADS. And same for the P99, copy this, paste it here, and write CFADS instead of EBITDA. This will be given in dollars. And you know what? We can actually group this stuff here together. It's kind of distracting. This Shift-Alt-Right key, so we can hide this. So we just see our actual taxes for these cases. Pick up a raw total, copy this, paste it twice here. And then we can calculate our P50 CFADS, which are simply our P50 EBITDA minus our lever taxes on a P50 production scenario. Hit enter. And same goes for P99 CFADS. This is our P99 EBITDA minus our lever taxes on a P99 case. Hit enter. Now actually this labeling here is misleading. It's not the live case, so let's change this. So this should be the same label as right here. Copy this label, paste it here. Same goes for this one. Copy this whole formula and paste it here. Great. Now we can drag this formula over, Control R, and we get 755 million P50 CFADS. which aligns with this value up here. Now let's see if we get 584. On this case, actually it's 574, which aligns with this number here. Now, if you ask why this number has changed by changing the production scenario, that's because we are still in our live case structuring and referring to the wrong CFADS to model our ultimate debt. So if our debt quantum here would have been frozen and just hard-coded, then these CFADS wouldn't have jumped, because the CFADS change in accordance with our levered taxes, which are affected by our tax-deductible interest expense. That's why these numbers here change, but that's to be expected the way we have set up the model so far. So we can delete one row here, and then we will have to implement another target DCR. Here we are referring to D47. So we can just drag that down, hit Control D. So we get the target DCR for the P99. Hit Control D here as well. So we're referring to our 1.0 DCR. And we can hit Control D for this formula as well. All we have to do is change the reference back to our debt turner flag, drag this over, Control R. And actually we also have to refer to the 1.0 DCR here. So let's drag this over again, Control R. So now we have two different target DCRs flowing through the model. Then this will be our target debt service under the P50 constraint. Let's add a couple more rows here. Hit Control D, and this will be our target debt service under our P99 constraint in dollars. Hit Control D for this one. And our P50 target debt service is calculated by an if error statement, if error K69. Now these are our live CFADS, and this is what we wanted to avoid. So we will drag this reference down to our P50 CFADS, which we calculated down here. Hit Enter. And then we can hit Control D and see what happens. For the P99 target debt service, we are now referring to our P99 CFADS, which are significantly lower, and our target DSCR on a P99 basis, which is 1.0. So now that we have changed both these references, let's take both formulas. Make sure you also pick up the P50 formula. Drag them over, Control R, and you can see this P50 debt sizing actually went up. Why? Because right now we are selecting the P99 in the live case, and now this is actually properly picking up our P50 CFADS and not our P99 CFADS. And we can see that our P99 constraint results in less CFADS than our P50 constraint. So my best guess is that this will actually decrease our levered IRR from currently 11.74% in a P50 production. But for determining this, we first have to determine our max allowable debt service, which will be given in dollars. Hit Control D for the row total. And this is simply going to be the min of either this number or this number. Close parentheses, hit Enter. Drag this over, Control R. Mark all of this. Let's actually have a top border right here. So this looks a little more intuitive. And now please note that our target debt service for sizing our ultimate debt is still picked up from this row here. So if we follow the dependence for this one, we are referring to two different rows here. So let's make sure we actually change our NPV of target debt service as well as our principal repayment, because we want this now to refer to row 131 instead of 129, because 131 is referring to both constraints. Remove arrows, hit F2, and here we sized our target debt quantum based on discounting our target debt service based on maximum allowable debt service. So let's refer to this row here, drag this over, Control R, and look at this, we get a fail up here. So that means that something is not adding up. And you can see that we get a fail right here because this number seems to now not add up. So what happens is we have still the reference to our target debt service on a P50 basis in this check, but certainly we want this to be based on this row total instead of this one. So we have to adjust our check, hit enter, and we still get a fail. But if you remember, we haven't changed our principal repayment reference either. So let's change it to our max allowable debt service up here. Hit enter, drag this one over, Control R, and now we actually get an okay. And the debt sizing seems to work properly again. Now let's see what happens if we flip back to our P50. So first thing I want you to notice before we look at the IRR, because a lot of students will ask, but what's with the net interest in the levered taxes? Why does this not impact our debt sizing? And what you can see is that this number here, 220, let's actually just pick this up, paste it as hard code here. So we can see what happens once we change from a P50 to a P99 live case. This number here stays the exact same. Also, if we select a P90, because what ultimately happens is our bank gives us two constraining factors on a P50 and P99 basis. And with those two inputs, we determine in each single period, just like the case study told us to do, the maximum allowable debt service. And you can see that in every single period, the max debt service is constrained by our P99 production, sizing DSCR of 1.0. And based on this structuring approach, we end up with this debt quantum that we can repay over a 20-year financing tenor. So that means that we have modeled everything correctly and are now considering our two constraining factors properly. Hit Alt-HEA to delete this hard code. And we can flip back to a P50 production to ultimately answer our case study question, which is the levered equity IRR higher with the second bank proposal? And our answer will be yes. Our levered equity IRR from bank 2 proposal is indeed higher than our initial proposal. So even if we don't manage to drop the P99 constraint, we would still end up with a higher equity IRR. So no matter what, it's worthwhile pursuing bank 2 instead of bank 1 to finance this project. Now, what I would like to point out is also that if I were the sponsor and trying to seek financing for this, I would go back to my technical advisor and ask them, why is the uncertainty for a solar project so high? Because if you get this uncertainty down, let's say to 5%, which is more industry standard, we can flip back to our calculation sheet and see that in this case now, our P50 would actually be the constraining factor, which would leave us with way more leverage, and we would be back to the levered equity IRR, where the P99 is not a constraining factor, but instead the P50. So that is another way of actually gaining that extra leverage boost or equity IRR boost by simply going back to the drawing board and questioning whether this uncertainty should actually be 10%. And if you can think through these drivers, equity IRR drivers and debt sizing drivers in such an integrated way, and you can vocalize that during your interview process, then you will certainly stick out from the crowd if you can explain this live to your potential employer, how you can actually enhance equity IRR in this case study. But let's flip it back to 10% now, given that this is our case study. And just a couple of things here. What you will notice, and if you decide to play around with the model, you might want to see what happens if I actually decide to have a 1.0 P50 DCR, which would essentially mean a cash sweep. So let's first look at our integrated financial statements for now. You can see that we pay out quite a significant dividend over the first years. And if we were to change our target DCR to 1.0 and go back to our statement, we would still have dividends paid out. Why? Okay, I just remember we haven't fully integrated our model logic yet. So let's flip that back to 1.0. What we haven't done yet is actually implement our toggle for toggling on and off our P99 constraint. So let's do that now. We can pull in our toggle here, which we have right here. Hit Control 1, select the custom style, on off, Alt HJ, off sheet. And for our max allowable debt service formula, what we will do is we start with our toggle, which in this case is on. So hit a 4 once. On means it's a 1. So 1 times our min function. If it's on, we want this formula to be active. And then we will say plus, in parentheses, 1 minus our toggle. Hit a 4, close parentheses. So if this is off, then this will be zeroed out. This formula will be inactive. But 1 minus 0 will make sure that the second formula is on. If this is toggled to 1 or on, then this 1 minus 1, the second formula, will be zeroed out. And if our constraint were to be off, we want just to pick up our P50 constraint. So all we do here is multiply our row 129. Hit enter, drag this over, Control R, Control Z. Let's do this again. Let's actually just copy this, paste the formula, Alt H VSF. So we keep our formatting. Nothing has changed. Why? Because our debt sizing constraint is on, but now we can actually toggle it off. And now you can see we get significantly more debt, or quite a bit more debt. We are at our higher levered equity IRR. And now you can see we still get paid quite a dividend in the beginning. Actually a little less than before, but what you have to consider now is that we need to put down way less equity. So if you pay out less equity upfront, we also need less dividend to actually achieve a higher equity IRR. But if you want to play around now and say, let's have a 1.0 DCR, which is an effective cash sweep, you will see we will not get any dividend for the first 20 years until the financing tenor stops. And our total equity is 10% of our initial investment, because in the previous case study, we have constrained our debt at a 90% leverage. And you can see there's a fail, and this is what I wanted to get to. So in case you want to play around with the model, we will have to adjust this check here. But let's first go back to the statements. And what I also noticed here is that once you have iterations in your model, there are always some rounding issues. And you can see that our dividend here is technically negative, but it's so far in the decimals that this is really just, a technical Excel issue. So for our check negative cash balance right here, we will actually say we round this number to 0 digits, drag this over, and then we won't get this check right here. And then let's go back to our calculation sheet. And now if we go into this check right here, you can see we only look at our actual debt sculpting approach and completely neglect our max debt according to max leverage ratio. And this is why we get a fail right here. So what I would suggest to do instead is we add a little if function here. So if this value right here in H143, which is our max debt according to maximum leverage ratio, equals this number right here. But since this is positive and the drawdowns or principal repayments are negative, we say minus this reference here, minus J149. So if that is true, if those two numbers match, then we want a 0. Otherwise, we want a 1. Close parentheses, and we will multiply this formula with our round check right here. So what happens is that if this is our debt constraining factor, the 90% leverage, then please ignore our max allowable debt size according to debt sculpting, because this would, in this case, be higher than our max debt according to the leverage ratio. And if that is the case, if these two numbers match, we want this check to be turned off, which is essentially a 0. If that is not the case, if these two numbers do not match, then we want a 1 and this check should be on. Hit enter. And now we don't get a fail anymore, so that's great. You can also notice that our levered equity IRR in a full cash sweep scenario is actually less than it would be with a 1.2 DSCR, or slightly less. Why? Because if you have a 1.0 DSCR and we essentially don't get an equity dividend for roughly 16 years, the IRR calculation really punishes late cash flows or doesn't value later cash flows as much as earlier cash flows. You can see in the year 2043, within just 1 year period, we already have almost our initial investment back, but it's so far out in the future that this doesn't really boost our equity IRR a lot. What you can also notice is that in a full cash sweep scenario, now that our maximum leverage ratio is the constraining debt factor, our debt actually is repaid in 2042, which is before our debt sizing tenor ends. How come? Because if this is the constraining factor and not the CFADS here that are utilizing a 20-year tenor, we could technically raise more debt than 90% leverage. But if this is our constraining factor, we will be able to repay debt faster than the 20 years, although we would have sufficient CFADS to leverage further or for a longer time. Great, but let's actually switch it back to our original 1.2 DCR and 1.0 on a P99 basis. Now, really important, don't forget to save this file. So let's do this now. So let's just call this end file, or you can call it final file. Hit enter. Okay. This all looks good. Let's scroll all the way back up. And we can do our final save while being in this sheet here, so that when decision makers open the file that you sent them via email, they can clearly see the outputs and that you've calculated all the numbers that have been asked for. All right, guys, if you made it this far, huge congrats. This was one of the trickiest modeling challenges so far. By the end of the exercise, you should now have a dynamic structure that sizes debt using both P50 and P99 production constraints, and clearly shows how that impacts the levered equity IRR. What we found is that pursuing Bank 2's proposal does improve returns, and if you're able to negotiate away the P99 carve-out, the IRR improves even further. So yes, it's definitely worth pushing for Bank 2. Now, this kind of insight is exactly what investors and lenders look for. Not just a model, but clear scenario-driven recommendations. You can download the completed Excel model and case study PDF from the full course on renewablesvaluationinstitute.com. The link is in the description. If you found this helpful, please leave a like, drop a comment, or share it with someone else preparing for modeling interviews. It really helps RBI's recognition grow further and keeps me motivated to create more videos like this. Thanks again for watching, and good luck crushing your next modeling test.